Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Welcome to Game Plan for Retirement, presented by Chris McIntire, Northwest Ohio's retirement planning resource.
And welcome into the program. This is your Game Plan for Retirement with Northwestern Ohio's resource for a common sense approach to planning for our financial investment and retirement future, helping to uncomplicate the money world. He is Chris McIntire, president and founder of McIntire Retirement Services. And Chris, always a pleasure. Great to see you as always, and we appreciate the time and the insight that you provide here.
Yeah, my pleasure, Peter. It's good to be with you here one more time here in the Outer Banks of North Carolina. For those of you looking on the podcast, this is not my normal yellow background.
No, doing the show a little remote. How have things been down on the Outer Banks? I know some storms came through there actually recently.
Sure. Yeah. And they get a little bit of everything about this time of year, but it's not 40 degrees and rainy like it is in Ohio. So it's nice to get away. And thankfully, with all the electronics, it's pretty seamless in all reality.
Yeah. Still able to stay connected.
Yeah, and sometimes that's good and bad, right?
Yeah. Well, I mean, sometimes we need to unplug, but I'm sure, especially like when things are in flux, the bank news that has broke recently, and with Silicon Valley Bank and people concerned, you want to also be able to stay in touch with clients to address concerns, right, Chris?
Yeah. And, we've been down here the last couple of years, Peter. And, a lot of times my wife and I, Robin, will say, look, we work on the business, not always in the business. So, we had about 3 different projects that we've got going. We got some client stuff we're going to be doing later in the year that we planned for, touch base with some other clients around this banking side of things. You and I, we've done some radio shows, some other video things as well. We've got a couple of employees that are going to be joining us and making a list of all the things that we need to do to bring them on board here over the course of the summer to, kind of help ease the burden, right? Growing business, you need more folks. You know that as well as I do. And, we're real excited about that. This is not a formal announcement, but just some of the things that we get to work on while we're away and, and stay in touch, thankfully with the internet and all that, it's pretty seamless, doesn't really have any impact on how we, make investment decisions. I actually get to read and study and do a lot more, to be honest with you. So it is nice to have some of these things, throughout the course of the year, as you know.
Well, of course, Chris McIntire is your local resource in and across Northwestern Ohio. If you've got questions or concerns, you are always welcome to reach out, be in touch, give a call to the office, or set up a time to speak with Chris, set up a time for that complimentary review, and get your specific and customized game plan for retirement put together in writing and in your hands. All opportunities on a no cost, no obligation basis, just a time to get more informed about your money. All you need to do is pick up the phone and give a call, 800-868-1194. That's 800-868-1194. Reach out to McIntire Retirement Services and Chris McIntire, 800-868-1194. You can also go online, lots of valuable resources available at McIntireRetirementServices.com. And today, Chris, going to talk about tax management. We've got some opportunities, in fact, a window of opportunity here for Roth considerations and really for tax management strategies, maybe to take the forefront as one of the most valuable things that we can do.
Yeah, that's a good way to bring it up, Peter, is a tax management strategy. We're working with several folks right now, some newer clients on, informing them of, how do we do, what's the difference between, doing a tax preparation at April 15th, where we're kind of in that tax season now, versus preparing for that April 15th event well ahead of it and looking at the tax rates, the income that clients have got right now that have come in, for the year. What are the opportunities to utilize? Is it Roth IRAs? Is it cash value life insurance? Is it municipal bonds? All those different avenues. And, I call myself a self-proclaimed tax geek because, look, we all work very hard for our dollars. Why not make sure you're keeping it. You could be the greatest investor in the world, but if the Internal Revenue Service is a 40% beneficiary of everything you've done, versus being a mediocre investor, but an incredible tax planner, you might be farther ahead and probably had a higher quality of life, to tell you the truth, just generically speaking.
Well, and Chris, being efficient with taxes, as you point out there, can be as or maybe more effective than shooting for higher returns. But here's the kicker: typically involves far less risk. So we don't have to be as risky with our financial strategies to be tax efficient either, correct?
Yeah, you're absolutely right. I liken it a lot of times, Peter, when I talk with clients is, your money's got to do some work for you, and the Internal Revenue Service gets paid off of that work that you do. That's why we've often talked about dividend paying stocks on many shows, that look, we get work for our money. We get the dividends, and, and trying to keep that work that you've done. That's, why tax planning is so very important. And, given today's world, the size of 401ks that people have, they've been putting thousands of dollars a year into these, than their previous generation. So the baby boomers are retiring right now with, 7-figure 401ks are all day, every day anymore, and you and I both know, hey, you turn the clock back 15 years, you very rarely saw that. Now you see that it's just every day, because people have been able to put more and more money into those 401ks, that nice forced savings, if you will. And again, as companies got away from, monthly pensions as well. So, the good and the bad, right? I don't have as much monthly income coming in, but I got a big fat 401k, and, all right, if you cashed out that 401k, how much do you have to pay the big bad IRS? So what do you really have versus, the net versus the gross is certainly, big differences.
Absolutely. Well, Chris, speaking of those 401ks, that is the way that this generation has been taught to save for retirement, and by and large has done a very good job of building up those 401ks, as you noticed and mentioned. Has that been the best way to plan, to defer and delay paying those taxes, or has that been a mistake to get into the situation where we've got these giant tax deferred balances?
Well, yeah, that's a complicated question that doesn't have a very, one-sided answer. So let's turn the clock back, and, companies said, hey, if you start contributing, we've got this employer-sponsored plan, a 401k, a 403b, if you work for a nonprofit, just to throw that out there. And if you put money into it for your retirement, we're going to add money to that. We're going to do the match. So you certainly want, how do you turn down free money, even though, you have to pay tax on it at some point in the future. So that was a good thing, obviously. Companies got away, it was their way also to get out of the pension side of things, was to, put people in plans, add dollars to them. As time went on, they expanded the amount of money that employees could put into those plans for their retirement. So, if you didn't need the money, if you're working overtime, you just put more and more of that money into that 401k. And that was the only option that they really had. Mid 80s, the Roth IRAs came out. Okay. And it took basically 30 years for Roth IRAs to be incorporated into Roth 401k. So many people didn't have this opportunity. And we're seeing it more and more. So we're looking at Roth 401ks, Roth IRAs, Roth IRA conversions from traditional IRAs, that type of thing. So I think this is, you and I have been talking about this for years. It's not certainly the first time that we've had this on the radio show whatsoever. For basically 10 years, we've been preaching Roth IRAs, and income taxes keep going down, down, down. When would you want to pay taxes? When they're high or when they're low? And they're obviously very low right now, Peter.
Sounds like you think that this has been a very good and advantageous thing for people to take advantage of. But Chris, it also sounds like you think and believe and are planning strategically with your clients that now is the time to go ahead and plan and prepare and to figure out how to effectively remove dollars from that tax deferred status.
Yeah, that's absolutely right. Because as we know, at age 73, the government has mandated you have to start pulling money out of those tax deferred 401ks or IRA accounts. Okay. That's at 73 now. Used to be 70 and a half. They bumped it to 73. Eventually, it'll go to 75. Okay. Now, they could legislate that and change that the next election cycle. Let's be fair. Okay. So if you're 60, or let me just say, if you're 59 and a half, that's kind of the magic number, and you've been putting all your retirement money into your 401k at work, okay, you can most likely take an in-service withdrawal, move some money into an IRA account, okay, outside of the 401k. Hey, maybe you look at a lot of different investment options that you didn't have inside the 401k, from growth to safe. You could, a lot of different options. We do it all day, every day. And then you could take part of that money in that IRA and convert it into a Roth over the course of time. So, you can manage this tax situation that you're going to have, and not just, have a panic attack on April 15th that you owe money. You want to do these things, well in advance, and talk to your CPA, your tax planner, to say, hey, what if we convert $20,000 this year from an IRA into a Roth? It doesn't have to be $200,000 by any stretch. Most of the ones we do for our clients, and even ourselves, in Robin and I, is, smaller amounts, that $15,000 to $30,000 essentially.
Well, again, if you have the opportunity to be more tax efficient, why would you not explore it, ladies and gentlemen? And Chris McIntire does that with his clients there at McIntire Retirement Services each and every day, helping proactive savers, investors, and planners to keep more of their money. That is what the message of today's program is about, that this window of opportunity is here, is now, and is something that you need to be paying attention to. Pick up the phone and give a call if you would like to explore options and identify strategies to keep more of your money, be more tax efficient, morally, legally, ethically, minimizing, reducing, or even eliminating unnecessary taxes. And Chris can help you quantify that. He can show you the strategies and show you how much they would save over time, side by side with your current path and with implementing some more proactive measures. That is what the game plan for retirement is all about. No cost, no obligation. You just get to see the numbers side by side. 800-868-1194. That's 800-868-1194. Call McIntire Retirement Services and your resource, Chris McIntire. 800-868-1194. That's 800-868-1194. Chris, a few reasons why now is the time. Number one, I think you've mentioned it a little bit here on previous programs, but the Tax Cuts and Jobs Act, which reduced all of our brackets across the board, was a temporary measure, and that is going to expire soon. The tax rates and brackets sunset, and we will see tax rates and brackets go back up.
You're absolutely correct. Yeah, in the year 2026, those tax rates go back to where they were in, let's say, 2015, for example, because when they enact these new tax legislations, they do that for a 10-year time frame, and then they sunset. They did the same thing with estate taxes. People will remember we were going to fall off the fiscal cliff, right? Because if they didn't extend. And who knows what they'll do. They may, they could certainly say, all right, we're going to keep tax rates as they are. We're going to increase them, and I suppose because we're doing a radio show here for the general public, they could cut taxes. But, if you turn on the TV and you watch this administration, cutting taxes is not something they want to do. They want more of your efforts.
Yeah. By show of hands in the radio audience, who believes taxes might go up into the future versus who thinks it might go down? I know I'm on one side of that, Chris. And along with the expiration of the Tax Cuts and Jobs Act on January 1 of 2026, a couple other things that were impacted by that I think are less mentioned than the rates and brackets themselves, which even that is not, I don't think, nearly talked about enough. But another couple aspects of that are the alternative minimum tax levels fall back down significantly, and the estate tax levels at that point in time, you just alluded to this, subject to change, also due to expire with the Tax Cuts and Jobs Act and be reduced significantly.
You're right, Peter. Yeah, there are many other taxes to talk about as well, and even capital gains taxes, what they're talking about right now. The president wants to increase capital gains taxes, increase corporate taxes, and increase income taxes. Imagine that, you get what you pay for, folks.
We've got several different levels of taxes. Before we kind of continue on with your list here, Chris, you've noted this before, but there's taxes on income, there's taxes on investments, and then there's taxes on your estate. There's a lot of other taxes along the way: sales tax, consumption tax, vehicle tax. I think there's 90 plus some odd different types of taxes, but those are the big ones: income, investments, and estates. And generally, the first one, the tax on income, is the one that is at the highest rate, correct?
That is correct, Peter. Yes.
Yeah, and the one on investments is the one that we have the most control over. That's what we're talking about here, is this window of opportunity to control the tax on your retirement account investments.
Yeah, you're exactly right. The more money you pull from those IRA accounts, the more money you're going to pay in taxes.
Well, here is another one on your list, Chris, as why this is maybe a window of opportunity to pay specific attention to. And this is a little bit of good news, bad news here. The depreciated portfolio value, the fact that we have seen the market pull back, may actually mean that it is a good time and a better opportunity to do some of this proactive tax planning.
Yeah, sure is. I was watching at the business channel on here next to me, Peter, before we started the show. And, from a year ago now, from today, a year ago, the NASDAQ, the tech sector, basically is still down 20% over the course of that time frame. The S&P 500, I believe it said it was down about 16%. The Dow Jones Industrial Average down about 10%. And, with rising interest rates, bonds are down in value as well over the course of, the last 12 months. So, you could certainly analyze your holdings and say, hey, why don't we take the Amazon stock that we bought in 2022 that took a hit and move it in from our IRA to our Roth IRA, and hopefully it's going to recover. And then, we'll pay a lower tax base on it when we convert it, and then let it appreciate over in the Roth IRA, income tax free. And again, just to be clear here for everybody, if you invested $50,000 into Amazon and today it's worth, $40,000, and you could slide that over into your Roth IRA, pay tax on the $40,000, and then hopefully you hold it and it recovers and, certainly gets above $50,000, $60,000, $70,000 as, hopefully it would grow, would be the idea there. And that's income tax free
if it's on the Roth side. So this is a chance. Yes, we don't love seeing losses. We don't want our portfolio value to be 15 or 20% less. Nobody does. But it's a chance to pay 15 or 20% less in tax and then recover, hopefully, tax-free. That's why right now, ladies and gentlemen, again, today's historic low income tax rates, the potential for that AMT and the estate tax levels to change, and also the fact that we are in a down market, the depreciated portfolio value, all reasons why now is a window of opportunity to do effective proactive tax planning. And if you'd like to look at the strategies for how to do that, pick up the phone and give Chris McIntire a call, 800-868-1194. That's 800-868-1194, 800-868-1194. And Chris, this next one on your list, I know it's been talked about, although not moved on quite yet by Congress, but the possible elimination of the backdoor Roth, or even, as you mentioned, they can change rules at any time, maybe the elimination of the Roth IRA altogether.
Yeah, they certainly can. It's a piece of legislation. When President Obama was in office, they tried to pass legislation that you would have to take a required minimum distribution from a Roth IRA. Right now, Republicans had the House and the Senate, so it didn't pass. But again, that's just the legislative risk, not to get into politics here with anybody. So the backdoor Roth, many people have heard that, don't know what that is. So take, for example, myself. I can't contribute to a Roth IRA because I make too much money, okay, according to the guidelines, okay? So the way I can do that is I can put money into an IRA account, okay, but I'm not allowed to deduct that contribution because I make too much money, they say. So I can put $50,000 into a non-deductible IRA account, for example, okay, I don't get to deduct that, and I can convert that into a Roth IRA then the next day. That's a backdoor Roth is what we call that. Okay. I do have to pay the tax on that 50,000. Okay. But then I can put it into a Roth IRA and grow it tax free. So they created the laws and they created a loophole for it as well, which doesn't make any sense. If you're going to do that, then close the loopholes, but probably it's an advantage to them as well, right?
Yeah, but certainly a strategy to pay attention to for those higher income earners, and may hear from other sources, oh no, you're eliminated, you're not able to make IRA or Roth IRA contributions, but there are still ways to do it. And Chris, they have legitimized this strategy, in fact, many times over, by specifically talking about it and not doing anything to make it against the rules.
Yeah, you're exactly right. And, I like cash value life insurance as well. I don't have to worry about all that IRS stuff with the cash value inside life insurance. I can put lots of money into that. So, that's also another strategy. I can borrow from my policy or against my policy. I don't get a 1099, doesn't show up on a tax return anywhere. If I do it the right way, it's tax free. So, the nice thing about Roth IRAs, yes, they are tax free. Okay. The other side of that is all that still shows up on your tax return.
Mm-hmm. Mm-hmm. So we got to be aware of that, again, that could impact other aspects of retirement planning. And right now it does not, but again, subject to change, could impact Social Security taxation, could impact Medicare premiums with IRMA, income related means assessment and adjustment. That is the means testing, the income based means testing for your Medicare premiums on Part B and D. So these are all things that make right now the window of opportunity to look at tax planning proactively, ladies and gentlemen, to look at your tax efficiency, to look at your lifetime tax strategies. Give Chris McIntire a call, 800-868-1194. That's 800-868-1194. Now, one kind of warning and caveat on that backdoor Roth conversion, Chris, don't you need to basically look at your complete tax deferred IRA balance and basically satisfy that before beginning a backdoor strategy?
Yeah, you certainly do. Yeah. Backdoors usually, we don't do too many of them, to be honest with you. It's a high income earner tool for middle America, which is the bulk of our clientele. We look at converting assets that are already in IRAs and 401ks, because that's where most of those dollars are. It's nice to know all the other strategies that are available. Of course, you deal with a doctor's office or something like that, where they have some special tax needs, to have the skills to do that. The president of a hospital or something along those lines, where you can have some of those advanced strategies available. That's where the cash value life insurance and a lot of those things come into play as well, Peter.
Well, you mentioned life insurance again, and Chris, number 5 on your list, legacy planning. The reason why right now is the opportunity to look at tax plans and strategies and efficiency is not just for our own lifetimes, Chris, but it is for the legacy planning implications as well. Roths and life insurance both fit that criteria, I believe.
Yeah, what would you rather receive, a $500,000 taxable inherited IRA or a $500,000 income tax-free life insurance death benefit?
Right. Yeah, absolutely. Makes sense to me. Now, Chris, I'm going to play devil's advocate because I can hear the screams and shouts. If I'm leaving money behind, then I'll leave that problem for others to deal with. But ultimately, we don't want to leave the IRS more than we have to. And when you have crunched these numbers and shown people side by side these strategies, oftentimes it is significantly less money to go ahead and handle that bill proactively, correct?
Yeah, you're exactly right, Peter. And, there are people that say, look, I'm just not going to worry about it. I'm going to, if the kids want to spend it, the kids can spend it. And I'm like, well, if they're going to spend it, why don't you spend it? Well, it's not something we've ever done, So it is definitely a generational conversation. But, if you're like, look, do you want to be leading the game at halftime or do you want to win it at the end of the fourth quarter? That's the thing, the red zone is the important part. And, as you get older, you get into that red zone, essentially, to throw a sports analogy out here is, what do you want to leave behind, and, a lot of people think of life insurance. I don't need life insurance, because your house is paid for, because your kids are gone. Do you, does it make sense as a tax planning tool would probably be part of our conversation. And, we've had enough long-term care conversations about life insurance being involved with that as well. We'll save that for another show again, I'm sure.
Well, again, you need to look at this proactively, holistically as part of your total plan from an income, investment, tax, healthcare, legacy standpoint, high-level planning, and then identifying the strategies to be as efficient and effective in each one of those areas. That's why Chris McIntire is your resource, ladies and gentlemen. Pick up the phone and give him a call, 800-868-1194, to sit down and design your game plan for retirement or review your current plan, your investments, your risk exposure, your risk tolerance. Make sure things are in alignment. Understand the risks that you're taking, the fees that you're paying, the taxes that you may be liable for, how to maximize and how to strategize and order in the correct order of operations income that you may need to take into and through retirement from your investment or retirement accounts. All of that is part of the game plan for retirement, a specific plan in writing. 800-868-1194. That's 800-868-1194. And Chris, number 6 on your list, to reduce or eliminate required minimum distributions, because even if we don't need income, if we've got these tax deferred accounts, the IRS says we have to take it.
Sure. If you're 73 years old and your IRA is worth $1 million, to use a round number, you've got to pull out about $36,000, let's call it $40,000, just to ballpark here and use a round number, whether you need it or not. And then that adds to your taxable base. It's most likely going to make your Social Security become taxable. 85% of it become taxable. Whether or not it makes your Medicare premiums increase or not is certainly a potential to happen. The larger the IRA is, and again, these are all things that are legislated. It's not like these things are set in stone and they'll never change. Tax rates have changed. Okay. IRA withdrawal rates have changed. The amount you have to take out has changed. When you have to take them out has changed with the stroke of a pen, and that's probably going to continue to ebb and flow as we get through, into all of the entitlement programs, right? We all know Social Security's got long-term funding issues. Medicare's got long-term funding issues. Medicaid, they want to give everybody everything. Well, where do you think they're going to get that money to give it away?
Yep. Well, that's why right now, again, proactive planners are looking at this window of opportunity while we know what tax rates are, and looking back with a historical perspective, are historically low. So let's take advantage of that. Let's do some proactive planning. The current tax rates and brackets are set to sunset and expire. Taxes are set to go back up, not just on the ultra wealthy or those making over $400,000. The truth of the matter is the 12% bracket goes back up when these expire in 2026, and all brackets across the board. So be proactive now. Look at those tax deferred accounts. Would you rather pay more and wait, or pay less and be proactive? Chris McIntire is helping to identify the strategies to keep more of your money. It's not what you make, it's what you keep. And if you'd like to see those strategies, quantify the dollars, the cost, the value, the savings of being proactive, pick up the phone, request your game plan for retirement. 800-868-1194. That's 800-868-1194. 800-868-1194. And if you have not had these conversations, that is just the tip of the iceberg of a hint of maybe missing more important conversations about your money. So pick up the phone again. Give Chris McIntire a call, 800-868-1194. That's 800-868-1194. Chris, always a pleasure. We appreciate you continuing to bring important conversations here about our money, about our financial and retirement planning. Thank you.
Yeah, my pleasure, Peter. And a quick note here is, when those tax rates potentially go from 12 to 15%, that's middle class. Our radio show isn't broadcast in Manhattan on Wall Street. It's Northwest Ohio. This is important stuff.
Pick up the phone, give Chris McIntire a call. We've got a window of opportunity to pay less in tax, to be more efficient and control that tax liability. 800-868-1194, the number to call. That's 800-868-1194 to reach McIntire Retirement Services and your resource, Chris McIntire. Thanks again, Chris.
My pleasure, Peter. Take care, buddy.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.